Good afternoon, everyone, and thank you for joining BNY Mellon's webinar today on why deferred compensation is disrupting earnings calls and becoming a source of liquidity and cost savings. I'll now pass it on to Ron Healy, who will begin with introductions.
Thanks, Armando, and thanks everyone for joining our NQDC webinar. Hope everyone's staying safe and adapting to the work from home environment. My name is Ron Huey, and I am the Head of Equities Institutional Sales at BNY Mellon Capital Markets. I would like to send a special thank you to Adam Tesler and our partners in Global Client Management in helping us to put together this webinar. On today's webinar, you can use the Q&A box on the bottom right of your screen to ask any questions. Only the panelists will see the questions, and we will have time at the end of our webinar to answer any and all questions. Now, to today's conversation around non-qualified deferred compensation plans and how to maximize performance using total return swaps. Recent swings in the markets has presented various considerations around NQDC structure and the impact to corporate taxes, fees, capital, and earnings. On today's webinar, you will hear from two industry veterans from our partner, Atlas Financial. David Marshall is principal of Atlas Financial Partners, which administers hedges for $4 billion in deferred compensation plan liabilities. Ben Eisler is managing director at Atlas, where he works with clients to optimize the hedging of their deferred compensation plans. Also on the call is J.C. Moss, head of institutional equities trading at BNY Mellon Capital Markets. His experience with the NQDC total return swap hedge goes back to 2012 when we first partnered with Atlas. And finally, thank you to Bob Polanski, the Assistant Treasurer of General Mills, who is responsible for cash management, capital structure, and capital market activities. General Mills has hedged its deferred compensation plan since 1999. With that, I'll turn it over to Ben to begin the presentation.
Thank you, Ron. So this is Ben Eisler with Atlas, and as Ron mentioned, we with our partners at Bank of New York Mellon, are very active in the executive benefit space. And our objective for today, in 30 minutes, 40 minutes, we'll be able to cover a good amount of ground in a relatively short period of time, is to give you the benefit of some significant trends that we're seeing in the marketplace. Next slide, please, Armando, that likely impact your deferred compensation plans, as well as what many Fortune 1000 companies, our clients, are doing to mitigate some of these issues. And we thought this presentation would be particularly timely and substantive given the significant turbulence and volatility in the investment markets right now. So we're going to cover three broad topics. The first is on this slide, which is the impact to operating earnings caused by deferred compensation plans. And then we'll also cover how, given current market conditions, many of our clients are viewing deferred compensation plans as a potential source of liquidity and cost containment. So we'll start with operating earnings. As shown on this slide, deferred compensation plans have been in the news a lot lately, and many Fortune 1000 CFOs on earnings calls have had to highlight significant swings in operating expenses caused by these plans. As an example, you can see here, you have a Fortune 100 company that was, quote, burned by deferred comp, and two other CFOs highlighting significant swings in SG&A due to their plans. These are just a few examples. And if this causes a little bit of heartburn, think about what some of the upcoming reports will look like. Next slide, please. So the culprit, as I mentioned, is non-qualified deferred compensation plans. For those of you who may not be as familiar with these plans, they're offered by the vast majority of Fortune 1000 companies to help attract and retain talent. But they also create P&L volatility. Plan liabilities and mark-to-market fluctuations flow through operating income. And this is an important point. Even if the company has purchased assets to hedge the plan assets, the investment income, flow through other income. And that results in a material mismatch for financial reporting. And this adverse impact is the same regardless of whether the assets are mutual funds or corporate-owned life insurance, also known as COLI, which we'll get to in a couple of slides. Next slide, please. And the impact to corporate earnings can be material. This graph illustrates the volatility in operating earnings from a typical deferred compensation plan liability. And quarter to quarter, it can be in excess of 20%. So what that means is for a $100 million plan, you potentially have a $20 million unbudgeted hit to compensation expense in a single quarter. Next slide, please. So traditionally, companies would address this issue in one of three ways. First, some companies, as shown on the left side of this slide, would leave these plans unhedged. And there, of course, was no real economic cost to this, but the company still had to wrestle with the P&L volatility. The second option, which is on the top right of this slide, has been to hold on their balance sheet non-operating investments in mutual funds and ETFs that are highly correlated to the investments that are selected by executives. And the thought had been that this directly eliminated P&L volatility, but in actuality, the accounting profession has taken a very strong, firm position on this, that the gains and losses for these investments must flow through other income below the line. So therefore, there's actually no direct hedging that takes place. And even if, as I mentioned earlier, the company's hedging with mutual funds or COLI, the company still has the earnings issue that we showed on the first slide, where plan expenses are recorded in SG&A, but the earnings of the assets are recorded in other income. So operating earnings are still very much impacted by the volatility caused by the plan. In addition, using mutual funds to hedge also ties up liquidity that could otherwise be used by a company's operating business, particularly if the investments are placed in a grantor rabbi trust, as many of them often are. The cost of funding is material, as corporate capital is being committed that could earn higher returns in another capacity, and taxes are also currently payable on realized investment income, which is also not ideal. The third option, which is now in the bottom right portion of this slide, has been to utilize something I mentioned earlier called corporate-owned life insurance, which many of you may be familiar with. A COLI is described as a portfolio of investments with an insurance wrapper. Basically, in exchange for paying fees, the COLI earnings are tax-free. The issue is COLI expenses are typically quite material, 100 to 150 basis points of asset value, and they may even outweigh the tax benefit of the COLI, particularly given the recent reduction in corporate tax rates. In addition to that, COLI has many of the same issues that mutual funds have. It's illiquid, ties up capital, you have the accounting mismatch, and there are some other issues as well without getting too far afield. Next slide, please. But fortunately, there's a solution that hedges the P&L volatility without causing many of these issues, for which we now turn to Bob Polanski, Assistant Treasurer of General Mills. Bob?
Thanks, Ben. Thanks for that overview of the importance of consideration of the impact of non-qualified deferred compensation plans on reported financial results. I'm Bob Polanski. I'm the Assistant Treasurer at General Mills. Most of you know that General Mills is one of the world's largest producers of branded packaged foods. Our company's purpose is to make food that people love, and I hope you are finding some General Mills brands in your pantries to make life a little better for you and your families while you're isolated in your homes. But today I want to talk to you about General Mills' deferred compensation plan and how we have used total return swaps to efficiently hedge the market risk exposure of our deferred compensation plans. As the slide shows, our plan is about $200 million in size, and we have 8 different fund choices. The annual impact over the past few years has ranged from $21 million of expense when markets rise to $1 million of income when markets fall. While this P&L impact is not huge for a company like General Mills, it is enough to make us seek a means to mitigate this P&L impact that the plan has on our reported results. Now, our plan is structured to allow the participants to make shadow investments of their deferred compensation, usually bonus, sometimes it can be compensation during the year, and they can defer this funds as a shadow investment into investment funds that mirror the funds that are available in our 401k plan. So the employees are very familiar with the various fund choices. And these choices are shown on the slide, as well as our company stock fund. Now, our 401k equity and bond funds are invested in both active and passive, but they're separately managed accounts that have specific investment index benchmarks. Because they're not totally passive funds or public mutual funds, we do have some tracking error risk between the actual results and the benchmarks that we would be hedging. Next slide, please. We executed our first total return swap to hedge our deferred compensation plan back in 1999. The structure of the total return swap is pretty straightforward from an economic perspective. For a specified notional amount, the swap counterparty agrees to pay us the rate of return on a basket of stock or bond indices that we've identified ahead of time, and we agree to pay the counterparty an interest rate on that same notional amount equal to LIBOR plus a spread. If markets go down, we end up paying on both legs. The amount that we receive or pay on the market leg should offset the plan's expense on the unfunded shadow investment funds, which makes the net expense basically the LIBOR leg cost. As the example on the slide shows, suppose the notional amount is $100 and the market basket goes up 10%. So the bank would pay us $10 and we would pay LIBOR plus a spread based on the $100. The $10 we receive from the counterparty should offset the $10 expense that we have in the fund if the matching is good. Now, from an economic perspective, this hedge converts the market-based risk inherent in the plan into a LIBOR-based floating rate exposure, which is something more easily managed by our FP&A team. There's potential for tracking error, as I mentioned, between the plan's rate of return and the returns on the index funds that are specified in the swap. This tracking error can be quantified and should be minimized by appropriate index selection. And we do this by periodically running regression analysis of the fund returns against the hedging indices to make sure that we have a good fit. Now, the economic results of the hedge work as we would expect, as shown above, but of course there's more to a hedge than just the economics. We must take into account the accounting and the tax implications of the total return basket swap. Next slide, please. So besides the solid economic hedge from the total return swap, there are other major advantages. As Ben mentioned, first of all, unlike an actual cash investment in underlying funds or an investment in corporate-owned life insurance, the total return swap uses no capital, since it is just a derivative instrument. Second, unlike an actual cash investment in underlying funds or an investment in corporate-owned life insurance, the financial results of the total return swap are reported in the same P&L line as the plan is reported. Mutual funds or COLI are reported as other income instead of compensation expense, which dilutes the perceived effectiveness of the hedge due to their being reported on separate lines. Now, as for the tax treatment, I'm not a tax expert, and David Marshall, who speaks after me, will explain this in far more detail than I will. But as a Treasury practitioner, the normal rule is that any cash that you exchange on a derivative swap instrument on a settlement is taxed immediately. So there would be a tax timing mismatch if the swap was taxed in the current period, but the tax effect on the deferred compensation plan is delayed until the deferred payment is made to the plan participant. However, under the total return swap, it is possible to delay the tax impact of the swap to match the timing of the tax impact on the plan. And David will describe that more in a few minutes. Another feature of the total return swap is that it is reweighted monthly or quarterly, which allows you to align the swap notional amount for each of the indices being hedged in the swap with the size of the various plan funds, because participants can make interfund transfers to move assets around, or they'll take distributions. Now, the benefit of this monthly or quarterly reweighting is it allows for monthly settlement or quarterly settlement with the swap counterparty, which also reduces the possibility of unsettled exposure to the counterparty. So you get better counterparty exposure management because you're settling quite frequently. Next slide, please. Now, let's talk about P&L volatility reduction. The guiding principle that we use at General Mills for all of our risk management activities is to reduce overall P&L and economic volatility on market-driven exposures. We don't claim to be for people who can foresee the future and have a crystal ball. We don't know if things are going to go up or down. Our job as risk managers is to manage the risk and reduce the overall volatility to our P&L or to our cash flows. We use this principle when we do our FX hedging, and we apply the same principle here for deferred compensation. So when we back tested this, we looked at the ratio on a quarterly basis of the volatility and the returns divided by the expense from the plan. And that ratio of volatility over expense fell from 1.7 times to 1.2 times. This is a 40% reduction. And you may recognize this ratio as the inverse of a Sharpe ratio, which shows that we have achieved significant reduction of volatility. Next slide, please. So graphically, it's shown here. This graph shows the results of our planned costs on an unhedged and on a hedged basis over the last 5 fiscal years. Now you'll remember that the stock market has provided pretty strong returns from 2016 to 2019, which gets back to the first slide that Ben shared about deferred compensation results having an impact on earnings reports from Fortune 500 companies. Now the gray bars show the unhedged plan expense. You see pretty large results and year-to-year volatility. This is what we're trying to eliminate. Now the gold bars show the P&L impact of the plan with the overlay of the swap hedge. This expense is significantly less volatile from year to year, and the slight upward drift that you see is from the upward drift of LIBOR over these years, which is exactly what you would expect to see. We are able to manage the LIBOR risk in our planning tools by looking at the LIBOR forward curve, which allows us to anticipate the future P&L impact of the hedge on the plan. If you further want to eliminate LIBOR exposure risk, you can enter into a floating to fixed rate swap. Now I'll turn it over to David Marshall from Atlas, who will discuss further the benefits of total return swaps.
That's great. Thank you, Bob. Very much appreciated. I'm David Marshall. I was involved in developing this strategy many years ago when I was at Goldman Sachs. I headed up the financial institutions group in the asset management division and also headed up a group called Structured Products. When the firm became a public company in 1999, for the first time in its history, it could offer deferred comp to its employees. Deferred comp really doesn't work well in partnerships. So I was tasked with the responsibility of developing a plan for the firm, and one of the requirements is we couldn't use our balance sheet. Goldman views its balance sheet as very dear. They prefer using it for proprietary business or for client business, and they really did not want to tie it up in any way. So it was during those discussions and working with a variety of professionals within the organization, we came up with the use of using total rate of return swaps that are dynamically reweighted. As Bob mentioned, we reweight these swaps every month or every quarter. Since we've implemented this strategy and gone to market with it in 2001 or so, we're finding that it's really being used by more and more companies. Since I've left Goldman in January 2008 and started this business with my partners at Atlas, we've been ramping that up even more. And based upon a series of independent benchmarking studies that we've seen out there, for most new plans that are being implemented by large corporations, this is the strategy they're using. Very few companies are using corporate-owned life insurance, for example, as the strategy for hedging their plans. A variety of reasons for that, as Ben mentioned. Corporate tax rates have declined, making the tax benefits of COLI less important. And when you compare those benefits to the cost of the COLI, it just doesn't work well. So for a lot of new plans, they're using the total rate of return swaps, but we're also assisting companies with old plans, finding ways to optimize those plans using total rate of return swaps. Right now, we're seeing quite a lot of activity in the marketplace because of current market conditions. Companies are looking for liquidity. They're very focused on operating earnings and OPEX, and they're looking for all ways to reduce costs. And so in working with companies, what we're seeing is there are ways for them to, one, suspend ongoing funding of any kind of plans that they have in place now, and really going forward, not funding it at all. With funding that's already in place, there are ways for us to substitute existing non-operating assets like COLI or mutual funds with more efficient strategies such as company stock or structured letters of credit. And then some companies are also using what are called springing rabbi trusts, where they will have a rabbi trust set aside for segregation of assets, but it's unfunded until certain events occur, such as a change in a percentage of share ownership or a change in the board or things of that nature, which would trigger funding of the rabbi trust.
David, did you want to go to the next slide?
I'm sorry, this slide 10. I apologize for that. So again, from a liquidity perspective, this allows companies to really free up assets, which is super important. From an operating earnings perspective, with the sharp market downturn, companies are seeing not only some market coming back, which is creating some expense for their deferred compensation plans, but there's just a heck of a lot of volatility and uncertainty out there. So a lot of folks are talking to us about ways to mitigate that risk, again, by using the total rate of return swap solution. And it's really something easy for them to do. It's easy to get implemented. It's pretty turnkey. It's an outsourced solution. And it allows them to insure against a lot of surprises that they're seeing right now due to market volatility. And then in terms of cost containment, by shutting down further setting aside of balance sheet and corporate assets and non-operating assets, they're able to reduce costs for the plan substantially, and we're going to get into that a little bit more. We can go to the next page, please. There are significant NPV benefits from the use of this strategy relative to other strategies that are out there. If you're using non-operating assets like COLI or mutual funds, those assets are rarely going to return anything close to your WACC, your weighted average cost of capital. It's not, and that's going to create an ongoing cost for the company. By using a total rate of return swap strategy, instead of creating a cost, you actually create savings and gains to the company over a period of time. As long as you believe that the weighted average return of the program is going to exceed LIBOR plus spread, then the TRS strategy is going to generate earnings for you. And in one study out of Columbia Business School, they found that for a $150 million plan, moving from hedging on balance sheet to the TRS created $94 million of savings over 10 years. And we've actually seen some even greater numbers for other situations. If the company currently is hedging with physicals, the TRS can free up those assets, as we said before, and you can then use those assets to reinvest into the company and your core business and get a higher return. If the company is not hedging, companies expect to receive more from the bank counterparty than they will pay over time, as I said before, as long as you believe that the weighted average return is going to be higher than LIBOR plus spread. With this strategy, as Bob mentioned, you have the opportunity for tax deferred treatment of any gains from the swap. We have a will level tax opinion from Cleary Gottlieb, and there's a private letter ruling that Goldman received backing the strategy. And as long as the plan is managed in a way and the taxes are tracked in a way consistent with the representations that were made to the IRS for the private letter ruling and are outlined in the will level tax opinion, you're going to be able to get this ongoing deferred tax treatment for the swap. And that could be a substantial benefit to you and your company. If we can turn to the next page, page 12. So hedging deferred compensation plans with total return swaps can provide material benefits around operating earnings, P&L volatility, liquidity, cost containment. And for these reasons, many companies are now moving to implement the strategy. It can be done quickly. It can be done in an outsourced way. It can be done in a way that your tax folks are going to be very comfortable with tax treatment. It can also be done in a way that it doesn't in any way require any changes to the plan or the plan record keeper. And there are strategies that we have in conjunction with the TRS strategy that would allow the plan participants to retain the benefits that they may be receiving today if you're using a grantor trust or a rabbi trust or some kind of vehicle for additional benefit security. At this point, we're going to move to a Q&A, answer any of the questions you have, and I'll turn it back over to Ben.
Hey, it's actually Ron, Ben,
Ron,
David,
okay.
Bob, thank you. We have a few questions. First question is directed towards JC. JC, what's the process for putting on the trade?
Yeah, sure. I can hopefully help answer that. Can you guys hear me all right?
Yes.
Yes. Loud.
Okay, great. So, having done this, a couple dozen times with different corporations, there's no standard answer to that. But the fact is, as was described by my colleagues and partners earlier, the structure of the trade is extraordinarily vanilla, very ordinary and not unusual relative to other equity derivative trades that typically go through a desk like ours. I suppose perhaps we can go into this a little deeper, although I don't want to get too in the weeds. But in general, these trades are done off of ISDA. They're over-the-counter equity derivatives. So typically, we will have terms in place under the ISDA umbrella with our counterparties. Now, that doesn't have to be the case. There's other ways around it. We can work with long-form confirms, which are basically just longer contract terms. But the way that the way the trades get put on is very simply coordinating with the trading desk, with us, in terms, and coordinating with your consultant in terms of determining what the best way to eliminate your liabilities is. When you get to that point, there's most likely going to be a few different ways to express it, a few different, whether you want to track the returns of an index, whether you want to express the index returns in the form of an ETF to simplify things. There's a couple of different variations on that, but in general, they lead to the same place, which is that you are effectively putting on a financial contract to eliminate some of the uncertainty and volatility that are native to deferred compensation plans. So I guess I'll expand a little bit. Typically, depending on what it is you are looking to hedge, there are different spreads to LIBOR. Those different spreads typically reflect some combination of the cost of hedging, cost of trading, and cost of funding the actual underlying instruments or index. So as an example, for instance, typically small cap equities trade cheaper relative to large cap equities, and that's because of the borrow premium embedded in the small caps. So small cap equities are famously more often shorted than large caps, and so as a result, the cost to fund them is cheaper because there's more demand for the shares. I don't want to go too deep in that rabbit hole, but it's an example of how the structures are priced, and at the end of the day, you'd be looking at an aggregate spread, at a weighed spread from the basket, and that spread would be the weighted average of the individual components, which are specific to your deferred compensation plan, and that's something that we can go into in detail. In terms of putting the trades on, typically they're struck versus the closing price or the NAV, or some combination thereof, as agreed between the trading desk and you, the end user. Again, highly customizable, highly flexible, not rigid, but typically this is usually done versus the close. And then monthly rebalances and reference to 1 month LIBOR is usually the default that we've seen. Although again, there's the possibility of referencing a longer interest rate benchmark. So I don't want to monopolize the conversation, but if there's any follow-ups on that, or if anybody wants to go in deeper into the implementation or the actual nature of the swaps themselves, I'm happy to answer questions.
That's great, Casey. Thank you. Next question for David. How do you free up assets held in a rabbi trust? Don't trusts typically require the associated liabilities to be fully settled before assets can be released?
Yes, so good question. There are a variety of different rabbi trusts that are out there. Some are revocable, some are irrevocable. I would say most of them are irrevocable, but they include substitution of assets language. And that substitution of assets language would allow you to replace what is in the trust today with another funding strategy that, as long as the trustee feels that that alternative is at least as protective for the plan participants as they currently have, folks can get comfortable with it from an HR and legal perspective. For example, if you have COLI, it's a little bit difficult to unwind just because there are a lot of embedded gains for which you haven't paid tax. There are ways for us to move the COLI out of the rabbi trust, surrender the COLI up to its tax basis. If you're in NOLs, which a lot of companies are right now, you may just want to just completely surrender the whole contract. And what you would replace the COLI with would be either company stock, which is a very, very popular method used by companies. They use their own stock in the rabbi trust. That doesn't create any kind of P&L volatility for them because obviously the returns for the shares would flow through equity. Another approach that companies have used is what is called a structured letter of credit. And under that strategy, you would pay a bank some nominal fee for the letter of credit equal to the amount of the liability in the deferred comp plan. It'd be an evergreen type letter of credit that allows you to renew it for a 5-year, let's say a 5-year period every year, so that it's always going to be in place. And then there are terms that are included with the letter of credit that allow the trustee for the rabbi trust to basically trigger the letter of credit, take the cash into the trust if certain events occur. And those events can be things like change of control, change of management, change in percentage ownership of the company. There are a lot of different rules that they have in place. And once they have that cash, then the plan sponsor is on the hook for paying back the letter of credit. The rabbi trust has no obligation to pay back that letter of credit. There are other alternatives too that companies have used. They have patents, they have receivables that they may be able to factor. The point here is we're trying to use something other than non-operating assets to create funding for the plan. And then finally, a lot of companies that we're working with right now are simply for new deferrals, telling the plan participants that the plan is no longer going to be funded within a rabbi trust. So all of the old liabilities are still protected by the rabbi trust, but they're no longer providing that option going forward. And so they can then burn off the assets that are in the rabbi trust to pay benefits for the old liabilities, and then use the swap going forward and would pay for the benefits out of general assets of the company. Hope that was helpful.
That was great. Thank you, David. Next question for you or for Ben. Apparently, some companies have been successful in convincing their accountants/auditors to remove the plan liability gain/loss and offsetting mutual fund gain/loss from non-GAAP earning results, effectively solving the P&L asymmetry problem. What are your thoughts on that strategy?
Ben, do you want me to take that?
Yeah, please go ahead, David.
It's great. You know, that's really, it's a challenge. and we were seeing this more in the past. We've found that the accounting firms are making it more and more difficult for companies to kind of argue that they're doing that. And we suspect they're going to continue to get tougher and tougher as the plan grows and the liabilities become more material. But we have seen that happen, and some folks have been able to argue that case.
Interesting. Let's see, a question for you, Bob. Why did General Mills decide against COLI or mutual funds?
Thanks for the question. I think the answer is what David's just been describing. We certainly did not want to use capital to fund the plan. And corporate and life insurance is very, very expensive in terms of the mortality costs and the other fees that are associated with paying it. And this just seemed like an extremely efficient economic hedge, as I described. Who I'm acquainted with Atlas, and their tool of doing the tax hedge matching, it really is, to us, the perfect solution for this problem.
Great. Yes, we hear a lot of feedback too on the COLI and the expenses associated with it. And that leads to the next question. If my plan is all COLI, can I get out of it and into the swaps, into the TRS hedge? Yes, Dave or Ben, if you have an answer, please.
I can jump in. Yes, you absolutely can. You always have the right as an owner of COLI to surrender the contracts, and there's nothing that the carriers can do to prevent you from doing that. Obviously the broker isn't going to be happy and they'll try to talk you out of that, but you are able to surrender the contracts. The issue is, how do you deal with the embedded taxes, the deferred taxes that you haven't been reporting for P&L purposes? And that's a real problem. Again, in current market, a lot of companies are seeing they have NOLs. This might be a way to kind of use those up. But most companies would just simply surrender what they call their tax basis in the contracts. That's the amount that you paid for the contracts, and then leave the embedded gains in the contract. And then as benefits are paid under the deferred compensation plan, they surrender those amounts and they get a deduction for the payment and they pay tax on the gain at that point in time. So they're kind of washing each other out. And then you can move forward with the total rate of return swap. Now, if the Rabbi Trust has restrictive language that requires that the trust remain funded, that's when we would talk about things like using company stock, or using the structured letter of credit, or using some other corporate asset that is part of its operating business. Ron?
Yeah, no, that's thank you. And I don't see any other questions at this point, but anyone interested in learning more, we're always happy to set up a call or a meeting one-on-one, probably a call in this environment. And we've worked with other clients around analyzing their current standing or their current plan, whether it's COLI or mutual funds, and put together relative analysis using the total return swaps. So with that, if there's no more questions, I'd like to thank David, Bob, and Ben again, and JC. And we look forward to speaking with everyone on the call further if there are any follow-ups. Everyone, enjoy the rest of your day and stay safe. Thank you.